time now to get our business update on the program, and I'm joined for that by Charles Pellegrin. Hello again, Charles.
Hi, Allison.
Charles, you are starting today with that much-awaited inflation data coming out of the U.S.
That's right. A little bit wonky, but the consumer price index for the month of September will be released later this Thursday, 8:30 a.m. Eastern Time in the U.S., to be precise. It measures the monthly change in prices paid by the average American consumer on a representative basket of goods. Inflation's been high, especially since the war in Ukraine, and analysts expect it to stay high in September because of rising rent costs. Looking at the annual rate, we're expecting an 8.1% increase in September compared to 8.3% in August, and to a peak of 9.1% in June. But if we were to look at core inflation, so excluding food and energy prices, that graphic would look different. Then we're likely going to see a 6.5% annual increase in September, and that would be a 40-year high. Well, this will be crucial information for the U.S. Federal Reserve as it prepares for its next meeting scheduled for November 1st and 2nd. And minutes from their last meeting released on Wednesday suggesting they won't be easing their monetary tightening anytime soon. This is their policy of raising interest rates in order to rein in price increases, in effect making it more expensive to borrow money. The account from that meeting says, quote, many participants emphasized that the cost of taking too little action to bring down inflation likely outweighed the cost of taking too much action. While some are concerned this hawkish stance could trigger a recession, nonetheless, central banks around the world are adopting the same attitude as the Fed, raising interest rates, including the European Central Bank. Its president, Christine Lagarde, spoke at the IMF on Wednesday and reiterated what her institution's mandate is.
As president of the European Central Bank, what we need to do is to return inflation to where it should be in the medium term, that is 2%. We are at a very high level, undesirably high at the moment, and we need to do the job that we have to do, which is to return to the 2% medium-term inflation that, for us, is price stability.
And ahead of that new data, let's take a look at how stocks are trading this hour. We're seeing mixed to lower trading on the main indices in Europe on the expectation that the Federal Reserve will continue to raise rates. We'll see the FTSE in London down by 0.25%, the DAX in Frankfurt down 0.60%, and the same for the CAC 40 in Paris. And we're seeing a similar picture in Asia as well. The Nikkei trading lower, down 0.60%, even as Toshiba stocks have shot up 9% after reports of a potential buyout. And a quick look at the market turmoil in the UK, where it seems we're not out of the woods yet, with government borrowing costs surging to their highest level since 2008. Well, this after the Bank of England signaled it would not extend its emergency bond buying scheme. The program was set up following a sell-off in UK government bonds caused by the unveiling of a mini budget of unfunded tax cuts by Liz Truss's cabinet. Well, that sell-off brought the country's pension fund sector close to the brink, which is what prompted the Bank of England to step in. Well, this time around, though, the governor of the bank, Andrew Bailey, told pension funds that they had 3 days left now and they have to sort it out. And after coming in for extremely harsh criticism from Washington for cutting its oil production in order to prop up prices, Saudi Arabia provided a lengthy response this Thursday, Riyadh saying that the decision by the OPEC Plus cartel was unanimous, contrary to claims that some in the alliance were against it, and not influenced by Russia's need to fund its war effort in Ukraine. The Saudi Foreign Ministry also adding that the U.S. asked the kingdom to delay the scheduled production cut by a month so it would take place after the midterms. And back from a cliff edge, Qantas, Australia's flag carrier airline, says it will return to profit this year after being weeks away from collapse during the pandemic. This in spite of a customer service crisis over the summer caused by the decision to cut thousands of staff during that COVID pandemic, leading to lost luggage, flight delays, cancellation, and rising prices. Well, in the first 6 months since December, the company expects pre-tax profit to have reached 1.3 billion Australian dollars, close to $820 million US dollars, so twice as much as market estimates, Allison. So really, people still looking to fly now after a lot of these restrictions have been lifted, and that makes up for what happened during the pandemic.
Yeah, interesting. Some rare growth in the economy these days. Charles Pellegrin, thank you very much for that business update.